Hello once again, Dave Knight here at Knight Capital Management. How do you follow up yesterday's video ranting and raving and having a good time doing it? Uh, that was fun. It's fun every so often just to just blow at the stack and alleviate the pressure and steam and all that other crap that's going on. You know, the crude oil market right now is currently where we have what I'd call extreme volatility. Um, like for instance, my proprietary indicator called the ADR that we use in our trading room. It is currently trading normal volatility, or I would say what would be um, a minimum volatility or average volatility, however you want to call that, is normally at 2.00 or so, right around that range. And I think at the beginning of May, it might even have been at below the 2.00. And currently today being Friday, it was at 6.2 today, which that means to us is that is 3 times the volatility on average. And you can trace it back to I think it was 6 trading days ago, when the crude oil market plunged about 10, $12 or whatever it was. And once we get that particular day off our trading charts as far as our calculations go, we should get, well, with everything being said and crude oil doesn't take off another $10 one way or the other, should be able to get back to some more normal average volatility. Maybe the average volatility is going to start coming in at 40 or so, or 4.00 or something. So the ADR is that calculation what I call the average daily range. It's not to be confused with the average true range. Now it's quite similar, but we take a different form of a calculation to get to this particular, and it's obviously a rolling moving average that we use on this. I guess you can call it a moving average because it works that way. It's pretty simple calculation once you figure it out. It's just getting all the components together to make it work, and then obviously that helped. Let's see if I can speak a little better today. Yesterday when I was ranting, I noticed that I was slurring my words together, and no, I wasn't drinking. I wished I had some beer and just started drinking right in front of you. But it is Friday. I should have cracked one open by now. But today, if you look back at the last few days of the crude oil activity, today being with Friday, today was at 6.2. Thursday was at 5.9. And I believe Wednesday was at 5.5 something, 5 point, I rounded up to 56. And then Tuesday was 5.2, which translates out to 52. Now, what does all that mean? Well, 52 is ticks. That means that on average you got to risk around $520 for every contract that you trade. And if you're only trading like we are right now, currently trading a small account in the room, it makes it difficult. For instance, if you're how do you make this? If I was trading 10 contracts or 10 cars or however you want to call it, or even 5, I would be decreasing my volume, my position size in the market in my money management plan to take account of the extreme volatility in the market right now, because it doesn't make sense. If a normal trade, let's for instance, let's say that our normal risk is 20, which translates out to 20 times 10 is $200. If our normal risk is $200 and now we're risking $600, so it's 6 by 2 is 3. So in other words, you get the 3 times the volatility factor that they're kicking in. So in other words, if you're trading 3 contracts at the 200 level, that means you should physically, if you're just taking a very, very basic concept here, at the 3 times volatility, you should be decreasing by 2 or going only in 3 here, 2 at 4, 1 at 6, right? So obviously that's just a straight money management, flat, fixed type of way of looking at it. But there, we have all kinds of things that we do and spreadsheet that helps us figure that out, and the volatility and other things that we use. But just taking a very straight approach to this, then you start to understand the extreme risk that you come in the market. So trading a 1 contract, and say you only have $5,000 in your account right now and you trade a day like today, And so at 62 translates out to, if you wanted to try to stay in this market on any swing that it might have had before it would have paid you off, you might have had to stay in for 62 ticks or $620. That translates, let's say you would crack up 2 or 3 losses in a row. You're looking at the first loss at $5,000 account at $600 or 620 roughly is 12% of your account. Now you're not trading at $5,000 anymore. You're trading at $600 less than that, at like say $4,400. Now if you would take that same $600 risk into about $4,400, that translates out to 13.6 or rounded up to 14% risk in your account. So you have, and if you lose that, then you're trading at 3,800. You lose another one, now you're down to 3,200. So you've lost almost half your account in 3 trades. Is it worth losing half your account on 3 trades where, for instance, at normal volatility at 2.00 around 20 or $200 per average trade, you could risk those 3 trades and you only be down $600. Instead of being down $1,800, you're only down $600. So you're only down one of the average trades. So does that mean that I can take on 1 trade at 600 if I was going to risk 600 anyway? Well, some people feel that way, that you can go about that, but the conservative approach is to firmly place yourself on the sidelines. And that's how we approached after Tuesday. We made our weekly goal on Tuesday. We were able to pull out $500 out in the market on Tuesday. And my small account that I'm trading, I don't want to risk on this extreme volatility market. I want it to get back. Once we knock off that one day where the market went like 10, 12, 15 bucks, I don't even know what it went, but it went pretty haywire before we even opened into the trading room, really. So it was just all day long, it just fell. If you go back and look at the daily charts, I believe, let me look at my charts here so I have you tell you exactly what day that was. That was on May 5th. Wasn't something happen on May 5th last year? Isn't that the flash crash day or somewhere around there? And then the flash crash happened around that area. Someone can comment on that and let me know. Wasn't the flash crash happened in May of last year? So, things that make you go, Anyway, the high of this day was 109.38 and the low was 98 and a quarter. So that translates out to what, $11 roughly almost? $11.13, I guess, to be technically correct about how far the market fell that day. And that's pushed a lot of the ranges out. Now, I guess you could have smoothed the average out, kicked that day out of your figure, and then you could have come in with another number. But that's not the way this calculation works, because the next day this market was going haywire. It was violent swings were happening, and you saw violent swings going on all the way up until, well, today kind of calmed down a little bit, being Friday's trading. You started seeing it get more to normal. Will we see normal trading on Monday, or will it blow up again? I don't know. Will Tuesday show normal trading? Hopefully the markets will calm itself down enough with the volatility factor, because we love volatility as day traders. We love that, but there comes a point that volatility is too much in your account, and therefore, if you've got $100,000 at this and you're trading, just throw out a number, 10 contracts. I'm not saying that's the right number to trade. I'm just throwing it out there. That, even at that point, you have to think about, all right, well, if I was taking on 10 contracts at $200, and if I would have to take away the average of 3 ports, that's like, what, 3.5 or so? Do I trade 3 or 4 contracts at this kind of volatility? That's just taking a flat percentage factor off, right? So 369, you have 1 extra. Hope this makes sense to you. Just wanted to kind of give you some feedback about, what this week was all about and whatnot. We're working in the background on one of my oldies but goodie trading strategies that I'm pulling back out. Actually, you do so many things over your lifetime as a trader. Sometimes you forget some of the things that you've put together. This particular trading strategy that I had comes back to I think it was October 20th, 2003. It's when I drew it up and so forth. And this is one of those things that's been working and continues to work and will work over and over and over again. But anyway, I digress. I want to tell everyone have a great weekend. Hope you enjoyed the last video. This one's a little bit more me being calmer again, right? So this is me being normal, and then the Irish temper of the other one. So, but anyway, I got rid of a couple yo-yos yesterday off my email list, so it's always bonus time when that happens. So, because you always know, if you haven't figured it out by now, that something good always comes after I do my thinning the herd type of stuff, right? All right. Dave Knight here at Knight Capital Management. I hope you enjoyed this video. We'll have a lot more training videos. I'm trying to, the Law of Success talked about the golden rule. It was actually lesson 16. And talk about obviously giving more back than what you receive. And I'm going to try to do more of that over the next, well, giving back more. That's kind of the key to being successful anyway in life, right? To give back more, therefore you get back more in return. I think there's somewhere in there. Is that the golden rule restated somewhere? All right. Have a great weekend. We'll see you on our next video. We'll see if we can shoot two or I'm just going to try to shoot 1 to 2 of these, me just sitting here talking to you. And anyway, that's about all I want to talk about. Take care, everyone. God bless you. Take care. Have a great weekend, and we'll see you on our next video. Bye now.